Good morning, everyone. I think we have admitted everyone that was in the waiting room. So just wanted to thank everybody for joining us this morning for this important press conference. Will you afford to retire? Unveiling the threats to your retirement. It's my pleasure to welcome all participants and journalists who are with us this morning. So today marks the launch of Better Finance's 12th annual pensions report, a publication that has over the years become a key and unique resource for understanding the state of pensions across Europe. In this year's report, we confront the troubling reality of the precarious state of pension savings in the face of rising costs and systemic inefficiencies. Over the next hour, we will explore several critical themes that emerge from our research. Our findings reveal that hidden costs within pension products are often draining savers' hard-earned contributions, while widespread inefficiencies in asset allocation strategies are stalling potential financial growth. Moreover, inflation continues to pose a silent yet substantial threat to the retirement security, undermining the purchasing power of savings and making it increasingly difficult for individuals to achieve a comfortable retirement. Sébastien Comin, Research and Policy Officer at Better Finance, will take an in-depth look at the report's key findings, focusing on costs, asset allocation inefficiencies, and the impact of inflation on retirement savings. The contributors to the report will discuss, amongst other topics, the asset allocation alarm, why most pension products miss the mark. Here we will examine the widespread inefficiencies in the asset allocation strategies employed by many pension products and how these suboptimal choices can hinder your financial progress. We will also address the cost conundrum, how hidden fees are draining your savings. Our research has uncovered the severe impact that excessive fees have on your pension and long-term savings performance, revealing just how crucial it is to be aware of the costs associated with your retirement plans. In addition, we will shed light on inflation, the silent retirement killer. This part will examine the significant effects of the inflation on your savings and the importance of ensuring that your pension products consistently outpace inflation to secure your financial future. And we will also tackle the pressing issues of transparency in the pension industry, exploring the challenges surrounding transparency. As many savers find themselves in the dark about their pension performance due to inadequate communication from pension providers, insurance, and regulatory bodies. We will have a segment focusing on the tepid rollout of the Pan-European Personal Pension Product, the PEP, where Jan Sebo will evaluate the challenges and opportunities surrounding its adoption. And then Laetitia Gabot will provide insights into the Belgian case, highlighting the widespread pension crisis and examining underperforming pension products that have left many savers vulnerable. After these presentations, we'll open the floor for a Q&A session, where we encourage you to engage with our speakers and delve deeper into the topics discussed today. Before we start, could I kindly ask all participants, please, to keep their microphones and cameras turned off unless you're invited to speak. During the Q&A session at the end of this press conference, I invite you to post questions in the chat or raise your hand. I will then put written questions to the speakers or give you the floor, giving precedence to questions from journalists. So thank you again for being here today. We are looking forward to an engaging session that highlights the urgent issues facing pension savers across Europe and advocates for necessary reforms to protect their interests. So let's get started. Sébastien, the floor is yours.
Thank you, Arnaud. So as Arnaud said, I'm coordinating this research with Jan Sebo. For me, it's a second edition of Will You Afford to Retire? And as someone in my early career, I have to say that I've discovered a lot of the pitfalls that await me in my retirement planning. So onto the research itself. First, our research this year covers 16 of the EU member states. We wish to expand that in the years to come, but for now, we apologize for all the countries that we cannot yet cover. In those 16 countries, we cover 48 categories of long-term and pension savings product for which we can obtain returns data and cost data. Among those, we have two public funded pensions in Sweden, the premium pensions, which are a special case, we shall see, 21 occupational private pensions, and 24 personal long-term and pension savings products of the type of life insurance or voluntary pension funds. In terms of the time span of our study, we cover returns data for up to 24 years. In some products, we cannot go that back to the year 2000, simply because either data is not available. As Arno already mentioned, we have transparency issues, a lot of difficulties to access aggregate data on returns, but also very simply sometimes because the product didn't exist in the year 2000. And that is especially the case of a product that is dear to our heart, the pan-European personal pension product, for which we only have 1 year of data because that's a brand new kid on the block. Now, the highlights for 2023, we had a good year as retail investors with a median nominal return after charges, so after deducting the cost of management, with 2 digits at plus 10.1%. And after correcting for inflation, receding inflation in 2023, we still have a real increase of purchasing power of those savings of plus 7.4%. Now, those median performance figures hide a great diversity with a best performance as high as 16.2%, but the worst one is in negative territory, meaning a loss of purchasing power of 2.8%. In terms of the cost, the median of product categories average cost remains stable compared to last year at 0.49%, so half a percentage point. And inflation, as I said, is receding. So inflation was the big concern of the past 2 years. We've seen the return of 2-digit inflations in many European countries in 2021 and 2022. In 2023, we saw a return to normal in most European countries, and inflation that falls back in an order of magnitude that is closer to the annualized inflation rates of the last 24 years. Now, what that means for the product in our sample is that most of the products we analyze for 2023 managed to beat inflation, which was not the case last year. Most of them had negative real returns. And only 9 out of those 43 product categories have negative real net returns in 2023. When we look at the picture, at the graph that I've included in the slide, we see that the situation is quite different from one country to the next. We have a few countries with very low inflation, Denmark, Italy, Belgium, and others where inflation remains high, quite higher than the average, the multi-year average. Countries like Croatia, Austria, Poland, Slovakia, so Central and Eastern Europe mostly. Now, the main performance driver of the performance of pension products is, of course, capital markets. And in 2023, we didn't have a bull market per se, but we still have a very strong recovery, especially of equity markets in Europe and even more in the US. So all products that have a middle to strong degree of equity exposures did perform really well. For the study, we always compare the performance of the products with a benchmark portfolio that we compose of half equity, half European equity, and half European bonds. And as you can see on the slide, that benchmark portfolio last year had a return of plus 11.8%. So we are a bit above the median return nominal terms of the products themselves, but not so far off. And after correcting for inflation, we have a benchmark at plus 8.1%, also above, but not so far above the median return of the product. Now, recovering capital markets, receding inflation means that 2023, compared to the last few years, was actually a good year, especially compared to 2022, which was a very bad year. 2023 is actually the highest median return in nominal terms of the past 5 years, with 10 plus 1, plus 10.1. And if we correct for inflation, we have a loss of return that is much less pronounced than over the past 2 years. Now, of course, when you invest in a pension product, 1 year, 2 years, or even 5 years do not matter much. What really matters is the long term. When you invest in those products, you invest potentially for decades. If you start early, you may be in there for 25 or 30 years. So that's why we look at holding periods of up to 24 years. And when we look at that, the picture is much uglier. In nominal terms, so before correcting for inflation, but after charges, over 10 years, the return is only 2.93%. Still good, but once you correct that for inflation, you fall to a plus 0.6%, meaning that the average pension product in our sample barely manages to preserve the purchasing power of your savings. And it only marginally increases the capital that you accumulate. Not really something you can rely on to supplement or even replace public pensions. Again, median values hide a great diversity. We have best real net performance at 9.1%, Sweden. And the worst real performance is actually over 10 years, is at minus 2%. So a loss of purchasing power of 2% for those products. If we look closer at the graph, we see that most products are in the zone within the box. And we see that for the 10 years holding period, that box is actually on the 0% line, which means that roughly half of our products are actually returning a loss in real terms for pension savers. Now, if we compare with our capital market benchmark, which is symbolized by the yellow diamond, we see that more than 75% of the product categories we analyze have returns actually below the returns of that capital market benchmark over 10 years. Which means, in short, that you'd be better off investing directly in equity and bonds. Over the long term, really high performance is the exception. And here I really want to single out the performance of Sweden's premium pension, especially the default option AP7 so far, which manages over 23 years of data that we could collect, manages to return on average each year 6.8%, which is way higher than products we have for similar holding periods. As you can see below, the maximum for annualized return for products with 24 years of data is 2.6, and that's the Danish industry-wide pension funds. And in those products, we have quite a number of products that return a loss over the long term, meaning that you accumulate your savings in products that cost you more than they yield. The difference is even more striking when we look at the cumulated return, of course. And there we see that AP7 so far returns in real terms after inflation and after costs 357.5% for its investors. We are way above even the most performing of the other products. Now, the comparison with the capital markets really shows us that most products lag behind capital markets. We hear the obvious contradiction that when we just look at the returns of the capital markets index, there is no cost, so the performance of the product will always be below. But they are significantly below. The average distance to the benchmark for the products that fall below the benchmark is 37.1 percentage point. Now, when we look at the returns and the allocation of assets in parallel, it's not exactly a full-fledged analysis that we do, but we just have a look and try to find some correlations, some relations. What we see is that for the products for which we have data on the allocation of assets, the median one-year nominal growth performance of the 5 categories that have that invest more than half in equity is in 2023 14.3%. For the 5 products with the smallest exposure to equity, so which we have on top of the graph here, is only 3.2%. So in a good year, you have a differential in returns that is incredibly high. And now if we look at the longer term performance, this sort of balance out because equity markets are more volatile than bond markets, of course. But we still have more than 1 percentage point of difference over 10 years. So the conclusion that we draw, but we need to explore that further, is that more risky asset allocation might be more volatile in the short term, but brings higher benefits in the longer term. Now turning to costs, and I'm mindful of the time. We have, I think, cost data is probably the type of data in our study that is most difficult to obtain. Most product providers are not very keen, let's say, to provide to disclose data on the full cost of that product. So the data that we have for cost is most likely underestimated, and especially for voluntary products of the pillar 3. But still, what we did is calculate the median of the average total cost of occupational products on one side and voluntary products on the other side. And we find a structural difference in the cost of those products. For 2023, we have a median cost for occupational products at 0.28%, roughly a third of a percentage point. For voluntary products, we see in the graph that there has been a decline in the cost from the high point in 2016, and that's much welcome. But we are still structurally higher than occupational products. There are good reasons for that. Occupational products do not have to bear the same cost of distribution, marketing, and so on. So, normal thing. But still, when it comes to designing a pension system, this is a difference that must be borne in mind. Why? Simply because when you calculate the accumulation of those costs over 24 years, for the average occupational product, you get a 12.2% of accumulated assets that go away as costs, while for personal pension products, you get 40.8%. So in terms of accumulating pensions, we are definitely not giving the same opportunity for the investor to accumulate retirement income. And that, in terms, result in a performance gap. Here you have the public pillar, which is basically Sweden premiums pension that have a very, very high 10-year nominal performance. And then occupational and voluntary pensions roughly in the same areas. But what we see is that the median performance of occupational products over 10 years is higher than the first quartile of the voluntary products. So here you see the effect of cost. Now, when we look at the real performance, so after adjusting for inflation, you see again that more than half of the voluntary products actually return a loss over 10 years. And when we think of that in terms of enacting policy on the distribution of long-term saving products, pension products, what information is to be given to investors, that must be borne in mind. What information do we give about long-term costs, about the effect of inflation, about the effects that selecting one product over another will have on your returns is essential. So I still have very 2 short minutes, less than 2 minutes, to lay out some policy recommendations, and I invite you to read them at the end of the executive summary of the report. We have 10 recommendations. We like round numbers. The first one is really for us, but also for all retail investors, more and better reporting of cost and performance data to supervisors and to the public. What we see right now is a diversity in terms of the reporting frameworks, what kind of data is reporting, how is it reporting, by whom, to whom, and that makes our life very difficult in terms of finding data that is comparable across countries, across product categories, and over time. It is actually a nightmare to reconcile some of those product categories. The second policy recommendation is to curb conflicts of interest. As I said, we see higher costs in voluntary products, and those products are recommended by salespeople working for product providers and remunerated by product providers. So that's a whole discussion on which Better Finance has been very active on inducements versus fee-based advice, bias-free advice. Again, I invite you to read our other publications on that, or get in touch with us if that's an issue or on which you are particularly interested. Third, and I will stop at that, I promise, is to provide better information to investors. And when we say better information, is information that they can actually understand, that is clear, that is concise, that they can empower them to make better investment decisions. I'll stop at that and give the floor back to Arno.
Thank you very much, Sebastian. I see that there's already a few questions in the chat, but we will keep the questions for the end of the press conference. So I will actually give the floor now to Jan Sebo, who will talk to us and explain a little bit more about the PEP product. Jans, the floor is yours.
Thank you kindly. Thank you for inviting me for this press conference, especially talking about the PEP, a new kid on the block among the long-term and pension products. Actually, I've been around the PEP since the idea emerged, I think 12 years ago. I've been able to comment and discuss the ideas how the PEP should be designed. And I had the opportunity also with my research team to be around the creation of the first PEP that has been provided since 2022, late in 2022, but for the first full year, we consider 2023. So if I may start my presentation, there are only a few slides basically discussing what we know about the PEP that has emerged, that is offered to the clients in several countries. The second slide will be about the performance of the PEP. No, and the last one about the recommendations. So regarding the pan-European pension product, what do we know? It's a new kid on the block that reflects the need for the unified approach towards our long-term savings. Why is that? Because it's really hard to explain to Slovak person, German or Italian or Spanish or Swedish person that if you contribute, let's say 100 euro for the 40 years into the pension products, well, your retirement pension pot will be different. It's really hard to explain because then you will ask so many questions. Me as a Slovak person, I don't want to save in Slovak pension funds because I know that the Swedish pension funds are better. Why I cannot do that? And the PEP regulation was answer to that. To have this unified approach, being able to save in a low cost, transparent product that will travel with me all around the Europe where I live, where I work, where I retire. So basically, what we know that the existing product do offer automatically the de-risking. There is a life cycle investment strategy and offers you the ability to de-risk or your exposure towards more volatile equity ETFs when you are in a later stage of your life. However, compared to most of the pension products, it will not end up 100% in bonds. It will end 60% in equities and 40% in bonds because it has been pre-tested before it hit the market. So basically, the creator of the product and the research behind this kind of product was done to ensure that you consider your saving phase and your payout phase, and you get most of it. And the most of it is the maximum pension pot, not the minimization of the short-term risk. Therefore, uh, the the PEP product that is on the market is well below the 1% PEA fee cap. I think it's a 0.6 plus VAT, and it's really transparent. Basically, you can see it on your mobile phone, every single contribution, the whole portfolio, which is not the case in many pension funds across EU, where where you are able to see the full portfolio. Here, you can see all the ETFs, how much you bought, how much you have in your product, and basically you are able to understand why my pet product is behaving and basically returning or performing as it is performing, because you are able to understand what the PEP has in its portfolio. Uh, the product is offered by Robo Advice Finax, which is a Slovak Robo Advice, and as of today, I think there are 4 countries where this product is offered. I think it's Slovakia, Poland, Croatia, and Czech Republic. Some other countries, I hope, will follow. So, how the PEP is performing? So let's have a look at that. On the next slide, you will see that the PEP product offers 2 risk categories. One is category 4, where you start with 100% in equities, 0% in bonds. And when you retire, you'll end up in 60% in equities, 40% in bonds. Using the regulation and RTS, regulatory technical standards, we try to understand what is the risk indicator, a summary risk indicator. It's a summary risk indicator 4. It means it gives you lots of volatility during the accumulation phase. However, you receive lots of return. The second option is a little bit more conservative. You start with 80% in equities and end up 60% in equities. Total expense ratio is 0.72. Of course, it's 0.6 regarding the management fee plus 20% VAT if in the country where it is provided, the VAT applies on this kind of financial management services. It has significantly outperformed compared to UCITS funds benchmark. We have compared it to more than 2,000 UCITS funds and ETFs funds that are offered on EU markets. And we have to say it's a best in class compared to pension products in Slovakia. But as Sebastian mentioned, it's really exception, the performance also compared to other pension products. And if I may ask Sebastian or our colleagues to click it, on the graph, you see the nominal net in after fees performance compared to UCITS funds of different risk class. Risk class 3, it's a typical bond funds, bond UCITS fund. Risk 4 is a balance, let's say 50-50. Risk class 5 it has, let's say, 80% of equity-based ETFs or equity-based investments. And risk class 6 is a typical full equity UCITS fund. However, both of the PEPs has outperformed after fees the UCITS funds, while this full equity PEP product has had the performance for the 2023 of 15%. And this little bit more conservative PEP product with 80% in equities had the performance of 13.4%. So the recommendation, the last slide, understanding the PEP, understanding the regulation, understanding and being able for more than 10 years to compare other pension products across the EU, we now can claim that the design of the product is what matters. If you design your pension scheme in a way that is forcing the pension providers to invest in bonds, they will do so. So basically, design is what it matters. When you look closely at the design of the PEP product, when you look closely at the design of the APA 7 SAFA pension scheme around it, you will understand that these kind of products are or will also for the future perform better than the other funds. It's because of the design. It's not because of the ability of investment managers to be able to choose a better performing investments. It's a matter of the design. So therefore, the first recommendation is also for national professionals regarding the pension schemes. Look at the internal design of your pension scheme, pension products, test it before you provide it to the consumers. And this is what is also in the PEP product automatically. It is pre-tested before it is offered. You cannot say about many of the long-term and pension products that they have this kind of feature. So another recommendation is really create a friendly environment for the PEP. EIOPA has published two working papers or research papers recently on this subject matter, and in both papers you will find that PEP do not have the same conditions as other national long-term or pension products. We can say that in many countries, the PEP is facing really unfriendly environment. So now the recommendation is to remove PEP discrimination and level playing field in the taxation for PEP, pension and long-term products. They have to compete on the same level playing field. And of course, try to integrate the PEP products into national pension strategies. Most of the countries, they claim that we have created a pillar 1, pillar 2, pillar 3. This is our national pension system, and we don't want this kind of, let's say, artificial or EU product in our system. Please do calculate the design and take into account the design of the PEP and ability of the PEP product to serve the future or potential pensioners. And this can be done by the third recommendation, to provide unbiased information on expected pension benefits. So please do provide us as savers with a pension dashboard so we can understand what we are facing in 10, 15, 20, 30, 40 years down the road when we will retire, and we will be able to prepare for it and save enough. So let the ability of pension products to cover the income replacement rate gap, because this is what matters. The pension products are not here to provide us with a low volatility, path. The pension products are here to cover the ultimate risk, and it is adequate pension income. I have 30 years to withstand the annual volatility. So this is the findings for the PEP and the presentation regarding the PEP that is on the market for the first year, basically, and the recommendations how to improve the environment for the PEP products. So thank you kindly.
Thank you very much, Jan. Again, for any questions about the PEP and other questions, we'll keep them for the end. So now we'll move on to the last presentation of this press conference with Laetitia Gabot, who will provide insights into the Belgian case. Laetitia, the floor is yours. Laetitia, yes.
Okay, I'm here. Good morning, everyone. So I will present you as a country case Belgium, so the results. We start with some figures, so we can move to the slide. Some key figures for the in 2022. So we are regarding the second pillar and the third pillar. So for the second pillar, occupational pension plans represented 115 asset under management, and they were managed by 25 insurance companies and 138 IROPs. There's a good coverage of the population with 84% of active population is covered by at least one product. And regarding the third pillar and voluntary pension product, on one side the pension saving plans, and on the other side voluntary insurance products. So the assets under management were around 54 billion euro in 2022, and the coverage of the population is quite good. More than 2/3 of the population is covered by at least one product in the third pillar. So we can move to the other slide. And now we are comparing different products. First, we are comparing comparing IRPs in Pillar 2 and pension saving plans in the third pillar, because these two products evolve in the same way over the time. So they have their performance quite similar. So, for example, in 2023, the performance was around 9% for both products. And if we look in cumulated returns, the performance, it's quite over time. And the only difference that we can see that in from 2018 and to 2021, there is a gap of performance because the negative performance for pension saving plans was higher to those of IRPs. So, and we can see that real annualized performance is quite low, and there's a big erosion of the purchasing power of the savings due to inflation. So that's all. We can switch to the other side, please. And in Belgium, the most important product are insurance product. In the second pillar, there are insurance groups products, and in voluntary in the third pillar, there are voluntary insurance products. And the problem is that for those products, we do not have information. There is a big lack of information, even if these products represent a large part of assets under management in second pillar and third pillar. Assurance group products represented around 2/3 of asset management in Pillar 2 and more than half of asset management in Pillar 3. So, but it's very difficult to find information on performance. We can find information regarding costs. FSMA published some reports in which we can find information, but Assuralia does not publish information on these products, even if it's a large part of Pillar 2 and Pillar 3. What I can say that in Pillar 2, branch 21 products have a minimum guarantee return, but which can vary from one provider to another, and there's a legal minimum guaranteed return of 1.75% since 2016, and this legal guarantee return didn't increase since this date, and it will increase in next January to 2.5%. Okay, and now we have tried to compute a performance for this product. So we analyze the data provided by insurance industry, and that we can find at national Belgium national banks. And we can see that for assurance group branch 21 products, the performance over the whole period from 2022 to until 2022 was 1.7%. So we can see that the cumulated returns is higher for insurance group branch 21 products than for IOPS or pension savings plans, but it's due to the fact that there is a legal minimum guarantee capital return, and that this return was 3.75% until from 1999 until 2016. And so this return, the cumulative return, include this return. It means that some products have still the past guarantee. So that's why it's difficult for saver to know exactly what is its performance, because it will depend on many factors. It will depend on the provider. It will depend also of the employers, because on the condition of the contract. And for insurance products that can subscribe a saver in the third pillar, when I notice that the performance is lower, and we can say that performance is lower. It's certainly because there is not the legal minimum guarantee return. So each provider, each insurer can provide the return he wants. So we can switch to the other slide. So in conclusion, we can say that annualized real returns after inflation and before taxation of all pension savings products in Belgium are quite low and are below 2% for the whole period. We can say that savers and employees should have access to better information and more transparent information, notably on their insurance group products, and notably on the performance of these products, because they can't have a clear information even on their mypension.be account. They can't find this information. So, and we can see that there is that charges and inflation have a real impact on these savings, and they should have a better information, and also on the better information on the legal guarantee minimum return. It will be better if you have visibility for the long term, if in the long term. And in the third pillar, it is also the same. Products should be more transparent on charges and on their returns. Yeah.
Thank you very much, Laetitia. Thank you. And many thanks also to Sébastien and Jan for their earlier presentations. We have some time remaining, so for questions. Should you have any, please raise your hands if you would like to take the floor, or post your question in the chat. I can start with the initial question already from the chat by Georges Mott to Sébastien. So the question is, are there any life cycle pension funds among those assessed in your study? If so, how do they compare with non-life cycle funds?
Yes, there are. One we already mentioned is the PEP. Of course, for the PEP, we only have 1 year of data, so it's really hard to say how it fares compared to products that have been around for a quarter of a century. The other very prominent life cycle product that applies a life cycling approach is Sweden's AP7 SOFA. They have basically two funds, one equity, one bond, and they use that as building blocks. In the AP7 SOFA system, it's a bit like the PEP. Design is similar, I think. You stay invested for 100% in equity until 10 years before retirement age. And as I showed in the presentation, that's a product with by far the highest performance in our study. Now, there are a couple of other products, usually parts of product categories that apply life cycling approach specific providers. So that doesn't show in the results. When we look at more fine-grained data, we see that some providers do apply life cycling approaches and have within their categories higher returns. So that's why at Data Finance we include introducing life cycling approach as part of our policy recommendations. For us, this is really the way to take advantage of the higher long-term returns of equity markets while de-risking your portfolio when you reach the end of your career at a time when you will actually need to make withdrawals from this accumulated capital.
Thank you, Sébastien. Are there any other questions? I don't see any others in the chat or raised hands, but if there are any other questions, the time is now. Doesn't look like there are any other questions. Seems like you have been very clear. Right, so if there are no other questions, I think we will I'll wait a few more seconds to see if anybody wants to ask something, but otherwise we will wrap this press conference up. So thank you all for your presentations, input, and for the enlightening discussion. So as mentioned, the pensions report will be published today on the Better Finance website, sometime this afternoon, shortly after the press conference. So we'll send you an email with a link to the pensions report. And so in any case, if you have any questions when reading the report, which is quite a hefty document, please feel free to reach out to us and to Sébastien, to myself, to any of the speakers or and presenters from this press conference. So if there are no more questions, I wish you all a great day, and thank you again for having joined us for this press conference. Jan? Yes, I think.
Thank you, Jan. Thank you, Laetitia, and thank you, Arnaud.
Thank you.